This is Justin Pulitzer. This is my weekend review video for Sunday, May 1st, 2016. As always, I'm overly ambitious with what I want to talk about, but I'm going to try and make this video a little shorter than usual. It's been going quite long lately, so let's just get to the heat of the action here. So I was trying to think about a theme for this weekend's video, and I was sort of thinking about hopes and fears. I think that's really what that's really what the market always preys upon, what people hope for, what they're fearful of when they get greedy, fearful, so on and so forth. And let's start off with the 6 market keys, flow into the 7 Fed keys, and then we'll hit up the indices and some big stocks, particularly some of the the momentum names that reported this week. So with regard to the VIX, I know that we had a little bit of a down move in the market. We have opposing tails here. Generally, I like to go with the last one, but I want to just show you where this peaked out. And I think that there's sort of a bit of a theme here, that there is a little bit of complacency, I guess, in the market. We had this period of low IV here with periodic spikes, I guess, on news or some fears. And that really kind of culminated in this flash crash. And my thinking here was that we could have been transitioning into a period of higher volatility. Notice the higher lows and the higher highs, but we've broken that, sort of snapped the fever, and we're kind of just hanging out around the lows again, kind of looking a lot like this period of time as well. So we've had moves that have made some attempts to get back into the channel, and they've all pretty much failed miserably. Even Friday's little panic move couldn't even close over the 50-day moving average in the VIX, and you still have the 100 and the 200-day moving averages well above. So that's sort of the tone with regard to volatility. There's really not that much panic in the market. I think that was also confirmed, and I hadn't been planning on discussing this right out of the gate, but I will. Why these poor lows here wound up being a long trade back to the upside. Take a look at the breadth down here. I mean, this is how it finished up. I mean, these are rather ho-hum numbers, 1.5 to 1 negative on the NYSE and less than 3 to 1 negative on the NASDAQ. At the peak, this was like in the 2s, mid-2s, and this was like in the mid-3s. That is not trend day type of breadth, and it didn't surprise me that we got some type of a pop into the close on frustrated shorts covering. You know, for this to have been, I guess, a move where you would have expected immediate repair. Often when you have poor lows, you get the back off. So I guess you could say we had poor lows here. This was the back off, and this should have been the corrective phase. But look at this. You have one tick look below and then bouncing. This, to me, is just algorithmic trading with people looking to run stops. And it did not surprise me to see the back off, considering the weakness in breadth. If we were sitting down here with 5 to 1 negative breadth or 8 to 1 negative breadth, this would not have been the kind of the long trade. I think, if anything, we would have had a break into the close. So if anything, internals are really important. I really can't stress that enough. You know, when you go back to, and I'm jumping around a little bit here just because it flows. When you go back into this period of time here, where there were all these days of selling, these days reminded me very much of the day that we had on Friday, because these were days with like 1 to 1 negative breadth, 2 to 1 negative breadth, 3 to 1 I mean, these were really not terrible days where the bears just kept on trying to push and sell off the market. So I think when you look at that in the context of what happened here with the VIX, that you keep rejecting at this area, that it shows that there is a little level of complacency and that people are expecting higher prices with regard to the market. Some, I guess, issues, some flies in the ointment. Something happened this week with regard to the dollar, and it's really very important. And I'll tell you, I had a mobile alert set on the dollar, and it was when we broke here. This actually happened. I happened to be out at the time having some drinks or whatever, dinner or drinks or whatever, I think at the time with a friend of mine. And I got an alert and I was like, wow, the dollar is below the Fed decision range. The market should be up huge. And the futures were down pretty big. And that was based on the Bank of Japan action that Kuroda didn't really do very much. They didn't, I guess he kind of pulled the Draghi, kind of whiffed it a little bit. But we do now have a breakdown of a pretty firm breakdown in the dollar range. This is the UUP, the instrument I like, the ETF for the dollar. So I'll show you something. We had this very dramatic run up, back off, and we've been in this consolidation range. I've talked with moves on the wrong side of the range have not been sustainable, although the dollar being a little bit, the upside here being a little bit more sticky. And we have now really kind of broken below the range with a lower low from this one, where we kind of went below, rejected back into the range, went below with a higher low, made a higher high, kind of tried to hold the range, and now have kind of firmly rejected it, and now we're below this low even. I don't know if this is going to turn out to be like an evening, like a morning star where we kind of gap up and it's up and away, and this is the low for a while in the dollar. Fully, if we get that, we'll countenance that as a row trade, meaning right or right out. But we do have a lower low off of a still lower high, and the pattern looks to me like the dollar is coming down. That means a more dovish Fed, likely. It also means that companies that do business overseas will have a lot less pressure on them repatriating their earnings, so earnings should go up a bit. We all know that the market is dealing with a bit of a earnings recession, so to speak. We've been having low-quality earnings come in. They've all been juiced up by, accounting tricks. They've been juiced up by firings. There's a ton of layoffs going on in big corporations. Automation, AI. I posted an article this week. I don't want to get too into it here. I'll see if I can find it. Maybe I'll put it in the description of the video here. McDonald's is likely to start using automation and AI, but there's a bit of a tug-of-war going on. Those of the bears saying that the market is trading at a high multiple, meaning 17 to 19 times, however you want to splice it. That's evidenced by big boy stocks like Coca-Cola. Let me see if I could show you this. Trading at 27 times earnings, all to chase a 3% yield. To give you a context of just how expensive that is for a company with very little growth making sugar water, Google is trading only slightly at a slight more premium with tons and tons of growth, and Coke is well off the highs. They've came down a lot. This had been trading close to 30 times. So that's to show you just how much money is flowing into chasing yields. Yes, that is unsustainable over the long run, but the big, however, is this. And we all know what that is. That is the bonds, the Fed, if you will. If you go back in a longer-term chart, and you go back to 10 years, this is the end of the world here. The 2009 crash peak, right? Lehman, Bear, TARP, GM, you name it. I mean, everything was kind of hitting the fan. And we are well above that area. That tells me there's a lack of money demand, and it tells me there has been really very little growth. And a lot of the move in the market has been because of low interest rates. I've discussed this in the past. This concept seems to be very difficult for people to understand for whatever reason. The media is very adverse to it. But I do have a finance degree. I actually have a double major in finance and marketing. The finance one is probably the one you're more interested in here at the moment. So let's talk about a little bit about how stocks are valued. They are basically valued on the expectation of future cash flows, and they are discounted with what's known as a discounted cash flow model, meaning how much are you willing to pay for future earnings today? And there is a discount rate, a hurdle rate, if you will, and it is known as the weighted average cost of capital, WACC. And a very large component. It basically factors in based on a company how much their their discount rate should be based on I don't want to get too into this because I could actually do a whole video on this, but what percentage they have as far as equity, what percentage they have as far as debt, what interest rate they pay on that debt, and so on and so forth. But a large component of that is the the risk-free rate, if you will, the Fed funds rate. And with this level, this low, that means that earnings, even low-quality earnings, are getting valued with a PE multiple premium, meaning multiple expansion. That is what's been going on in the market. So when you wonder why, you're seeing crappy, relatively low quality earnings beats. In some cases, they are very high quality, like in Amazon, but we'll get into that a little bit later. But broadly speaking, across the market, why is the market holding so tough and staying so high? It's all basically Fed. I hate to, sound like so broken recordish. I discussed this in the videos, but yeah, I mean, the Fed is the only game in town. We don't have that much going in terms of fiscal policy. We know the government is doing a lot to hamper business with, I just got a alert before I came on the video here where Baker Hughes and Halliburton, I think, are calling it quits with their deal. You have a lot of government intervention and protectionism. You have, they kind of screwed up the Allergan and Pfizer deal as well. So it just seems like you have the Obamacare tax, and you have them trying to raise minimum wages, all in the time where you want to stimulate businesses to, have, I guess, visibility. That's, I guess, the term that I would use, to be able to see further out so that they could make plans. The government is interfering and making it so that they don't have that visibility. And, that's one of the things the Fed is always talking about, that there's not a lot of corporate and business investment, and I think that's because of the type of backdrop in the environment that corporations find themselves in. They are facing a hostile system, but they happen to have the I always say, if you're on a plane, if you picture the economy and the U.S. so far as a plane, you have a lot of the engines out, but you have one of them firing, keeping up the whole plane, and that is the Fed with their zero interest rate policies and potentially coming down the pipeline negative interest rate policies. We know Europe and Asia are kind of moving toward that model. So you have a bit of a bull flag here building out, a little bit of lower highs but with equal lows. And as long as this double bottom here holds, I think you'll still hear the drumbeat for PE multiple expansion. At least you will from me. I don't know if you will from TV reporters, but you will from me. And even if you lose this area, you have many areas right below for major support, particularly near the 200 MA and the primary trend. You can see it's held many times. So there could even be a little bit of a breakdown here, but it not be all that much, and you have a lot of, volume memory here. And look where this is. This is basically the edge of this distribution. So you're in the upper distribution, touches to where the distribution separates have been met with buyers. They have been a little bit lower high buyers, but in the context of a downtrend, this is not very steep. I've also said that you don't really need this to be up and away. There is a zero bound, I would assume, for interest rates. I don't necessarily think we're going to go to negative interest rates here, but I can say this, that at some point people will, stop buying if there is zero return on their bonds. And I think that's really what happened in Japan. Kuroda, I guess, people, if you're playing for price appreciation in bonds, most people usually play them for yield, were disappointed with Kuroda because you didn't get the move up here, so they sold them and they took it down. So that's really what happened, in my view, with the Bank of Japan. Anyhow, that is the story with regard to the bonds and the PE multiple premium and multiple expansion. If anyone's really super-duper interested in that, I would be happy to discuss it in maybe a little bit more detail in Periscope. That's a really great Periscope conversation. Please leave a comment in the caption below after you've hit the subscribe button. And and the thumbs up button, of course. And leave me some comments. Let me know your feedback on that. I'm curious to see if you guys really have an interest in that. The high yield situation. One of the things Yellen has talked about, besides her concerns about foreign, I guess, the foreign woes over in Europe and Asia, has been her concern about the yield premiums from high yield over the risk-free, meaning treasuries. This has stabilized quite a bit. It is well over the 200-day. It held the 10-day like a champ on the pullback here, doing some nice consolidating. Bigger picture, still a long way from Kansas Toto, but also a long way from the lows. We got very close to the 61.8. It didn't quite get there, but it is reversed in dramatic fashion. As long as this is stable and not crashing like in this type of mode, you will not have a debt crisis. This is one of the reasons I got kind of jiggy in buying Credit Suisse and Deutsche Bank. Believe it or not, I'm going off reservation. I'm going rogue. I had zero intentions about talking about those in this video, but I'm going to. And I think it flows really well into the crude chart. So I'll show you this. The probability of companies going bust who have overextended themselves as this rises, that probability gets lower. So think about this as the over-levered oil plays. Their cost of capital, the tides of fear are receding. The same thing is happening in the oil market. The woes, the problem that had caused the woes in those companies was crude oil going down in a very rapid fashion. We are now in a rising crude market, evidenced by higher lows and now higher highs, with a breakout over this double top, a bit of a successful retest, and rolling higher. I've been saying for a while, I think 49s to 50 in crude. Still very possible, well over the 10-day moving average, well over the 20, well over the 50. Yes, this could pull back. It is very possible. It might not be a straight line. I'm going to talk a little bit about Exxon in a moment. But as crude rises, as the tide of fear is receding in high yield, that has also given way to companies that, or banks in Europe that have been suffering terribly from negative interest rate policy, not being able to, we see the problems with the multiples that we've had in the U.S. with regard to our banks not getting jiggy with it, so to speak, because their earnings profile, they've been regulated and they don't have interest rates, and these guys have it even worse, and they had the fear of those defaults. I had said that you kind of have to assume that the double bottom here was going to hold, and it did, and we've been doing pretty well. It had a little bit weak. There was a bit of a downgrade, I think, on this day, plus some general market weakness. It would not surprise me to see a retest here. Look, you gapped and went over the 20 and the 50. I really don't think it would be so unhealthy. Look at what resistance this had been. I think at the very least a retest would be fine. It would be great if it's the lower end of the range here. I think it would give a good right out buying opportunity. This is when I had got into it here when we made the downtrend break, and I actually had bought it this day. Took some slight heat here, but not very much. By the end of the day, I was back positive, and then it was gap and go off to the races. I just wish it was always that easy. Same thing in Deutsche Bank. Help if I could type. And actually get the symbol correctly. Same Michigas here. I bought, on the breakout of the trend. Took a little bit of heat. Not quite in the green that day, but really didn't have to suffer through very much being anywhere wrong in that. You can see the banks here are starting to get a little bit better. I had talked about Morgan Stanley in a couple of videos ago, about a bit of a cup and handle forming. That has now resolved to the upside. I like it anything over 26s, and I would love a row buy there. You can see the 100-day moving average here has held it like a champion. And yes, I like to play with words once in a while. So yeah, that would just be a retest mid-channel. I don't know that it doesn't get back to channel low here, but I do know that it is making higher highs off of higher lows. Pattern is improving. I think also these guys, the fear of their loan books are, the fear of that issue is receding. Wow, I'm really getting kind of cray tonight, right? EWZ, this is Brazil. We know that they're basically overthrowing their government. This has been going straight up. These are commodity-based countries that are doing much, much better here. I'm actually long a little EWZ. It's been going well. I was a little early on it, but doing quite exceptionally well on it now. I wish I was as max long as I had been near the lows. I took profits as it rose, but still long and doing decently. I'm actually looking for a bit of a gap fill all the way up to 33.84. I should actually put a sell order in, and I will do that when the video expires. Yeah, so we covered a lot of bases here. A couple little concerns with regard to crude. One was the ExxonMobil report. I had talked about booking some profits into their number. It actually initially was up quite a bit on their earnings. We know that Friday wasn't the most bullish of days, so it doesn't surprise me that there was a little bit of profit taking. One of the things that bothered me, you had a couple of things happen this week. S&P came out and downgraded ExxonMobil's debt. They brought it from AAA down one peg, but they said the outlook was stable. The very next day, ExxonMobil came out and did quite the boss move, and were like, "Yeah, we're raising our dividends." Okay, I get it. Totally get it. I'd probably have done the same thing, but I would have waited until earnings. Another day or two would not have been that big a deal. I always get really suspicious of companies. I had asked someone to come up with the one that did this. I was told it was Visa. I think I had tweeted about that they had raised the dividend ahead of their earnings once, and then they went down on their earnings. But I just find when companies do things like raise dividends, this was maybe a special case because of the downgrade, but I don't like when companies raise dividends ahead of earnings reports. I like when they do it at the time. I don't like when they're kind of like distracting from the news cycle. Anyway, I like Exxon on pullbacks somewhere in this like 84s, 70-ish to 83-ish area. Maybe a 50-day moving average touch would be very nice. You can see I drew in a bit of a channel. We're bumping up at the top of it. Maybe a move back down to the low part of it would be nice. XLE is another. Wow, this thing is in beast mode. Look at this. Totally long downtrend. Higher highs now, making higher highs off higher lows. Way nice break of downtrend. Look at this. Came down a little bit, muddled around, broke out, retested the backside, which is always nice, and has just been, up. I like that. I see up. It could make a move, believe it or not, back to 72.51, where I've eloquently drew in a breakdown point. I don't know why I drew it in there. It looks to me like it was really 72.43, but this chart probably goes back quite longer. I would stick by my numbers. So somewhere between 71.93 and 72.51, there should be some resistance. You can see this is where all of the dead bodies are. That's where I would think it would take some profits. And that would coincide, I think, with about $49 or $50 oil. So, yeah, let's get that done. China. Another big problem. I think this is why the Fed may have kind of backed off of their foreign issue, their concerns of the foreign issue. The problem here is you now have a break of trend. So I don't know how cray this is going to get. Look where we are. We're kind of on the edge of this distribution. If this does start coming down, I guess we could see a move back to the 50 and 100-day moving averages. I'd probably be looking to sell some out-of-the-money puts or very near dated for row situation, considering there's been multiple days of selling already. But, yeah, we could come back down to 32s. Very, very possible. I'm going to keep an eye on this. It doesn't surprise me. Speaking of China, I'll tell you this. I think the Fed has a lot of nerve not really playing up because, there could be that Brexit, the British exit, and that could get real funky. You also, I think, have some debt coming due with Greece. I don't know. The Fed seems to like to juggle what they're talking about, between the jobs and the junky growth and and I guess the foreign concerns. So, I guess at this particular juncture, they decided they didn't want to get too much into that. I will get into that, actually. I'd like to get into that now. I'm going to kind of jump a little bit. I'm going to jump into the 7 Fed keys just because I think that that's really relevant here to this discussion. The jobs numbers, the NFP, not that great. I've talked about this, the part-timing, the low quality of jobs, the lack of wage growth for years and years and years. It's just not a pretty situation. Again, the AI, the automation coming in, the higher they raise that minimum wage, the higher level, the more, I guess, sense it makes for companies to automate. Think about it. If you have to pay higher wages and more healthcare costs, it's much cheaper to hire or buy a machine that can do that. It's, we all talk, I always talk about the waiter, waitresses, bartenders, and carnival ride operator jobs. Think about what happens when waiters and waitresses at like big chains like Applebee's and Pizzeria Uno and Olive Garden are eliminated, and you just have servers basically because of being able to order off of an iPad at a table. This is real. It's actually happening. I've had it. One night I was at a movie. I don't really like those chain restaurants all that well. But those of you who follow me on some other social media know I'm a bit of a foodie. I can be a bit of a food snob. I grew up in New York. It's a little bit of, how we roll here. But I will say this, that I once got out of a movie. I think it was like maybe Christmas Eve or just a late night movie. And there was a Pizzeria Uno there, and I went in there, and I basically didn't even have to talk to anyone. I could just basically order off of the iPad. It wasn't an iPad; it was some kind of a tablet. And they only at the time had appetizers. But I asked the manager about it because this really struck me. I'd never seen this before, and he told me that they're going to roll it out for entrees soon too, and they're basically that's going to be the way it's done. So I have every reason to take his word for it, and I saw the CEO of McDonald's North America comment about that. It was a really striking article that he thinks it's going to happen there too. So that's the story with the jobs. The Atlanta Fed came out. They lowered their GDP to, I think, 0.8 from 1.2. I have to take a look back. I don't think it really matters the exact number. It's bad. It's below 2%, which is below the Fed's target inflation rate, which they've talked about that they can't reach for 2 or 3, maybe 2 to 3 years. I really don't see any reason for the Fed to get excited about raising interest rates if they can't even get the inflation numbers up to 2%. I had planned on showing you guys that Fed chart, the FOMC expectations number by the I think it's by CBOE. I've shown it to you before. I for some reason I'm not seeing that tab, but I'll just give you the skinny on that. They're all below 50% until you get to December, and December I think is even lower than it was last week. It's only about 60%. So I believe the Fed will go in December, do their one and done type of raise just to say that they earn their spurs or whatever. It's totally ridiculous. But it just seems very unlikely that the Fed is going to raise ahead of them, given the really rather crappy numbers we've seen in the first quarter. I mean, they were really just ugh. And that's been for like the last 3 years. I'm really curious to see after all the Q2 revisions and stuff what that's going to look like. We had some ISM and PMI numbers, the manufacturing, the service stuff, that had kind of broken the down streak, and then we've had some junky ones since then. I mean, they're not quite fully, nosediving into recession. The rate of change is kind of slowing, so I guess the pace of the decline here is easing a bit, but these numbers are not really that great. Durable goods numbers are also kind of not fantastic. A lot of the ones that the Fed likes to cite, they get excited about housing, autos, and planes and stuff. That's really what makes up these numbers. The housing is highly. There's a lot of it. There's seasonality in there. We had a really warm winter, so it helped keep that. I've talked about that. I live in an area where there's a lot of construction. None of that ceased at all this winter. They went straight through. They're all ahead of schedule. So I think a lot of that demand was pulled forward. We could have some junky numbers, believe it or not, coming up because as a result of that. But highly dependent upon interest rates. Same thing for autos, and we've talked about that we think we're in peak autos, and if they start raising rates, it'll be super peak autos. Aircraft, we know they've been easing back a lot from Boeing. They said that things weren't going so well, and then after 10 or 11, now 11 or so straight months, people finally got out there and they bought some toasters. But they bought their toaster, and I guess see you in about another 7 or 8 years for your next toaster. So wouldn't get too excited about these numbers. Let's get back to it, shall we? IBB. So this is another risk gauge type of measure. This is the biotechs have not looking very pretty here. You kind of broke, the up. I wouldn't say. Let me see. Hold on. Let me draw this trend in here. All right. So we didn't quite break the uptrend. We just got a 50 MA test. I'm cautious here. We broke below this breakout range high here, the 271.77, and below the breakdown low of the 275.40. It's only one day, and you've had 1, 2, 3, 4, 5 days or so of selling. If this comes back up, it's kind of no big thing, as they say. Sorry, I'm trying to make it. This is kind of dull stuff. I'm trying to make it a little exciting. Yeah, I mean, if this comes right back up, no big deal. But the longer we spend below here, it's not good. Look here, the 50 MA was the resistance. It should be the support now. So let's just use 50 MA. Any close below the 50 MA that kind of confirms, particularly with a trend snap here, would be not good. As long as the 50 holds, there can be a bounce. I'm not really loving it because of Gilead. So I really hate to be one of those, the I told you so's. There were so many people who were juiced up about Gilead with the trend line break. I said just to be cautious ahead of earnings. I know a lot of people did listen, but I know a lot of people were even arguing with me up until the earnings, and I don't think that they're not laughing now. So when you have a big move like this down, and then you have this like plodding long grind move back up to a gap fill, it often a little bit overshoots. This one happened to be a little bit, I would not even a huge overshoot, but it did break trend, which I think got people kind of juiced up. I said, and you were into a high volume node. I said, it was bullish as long as the trend line holds, but it broke here hard. I had said I was really worried about this. I said I thought it was time to take profits. Let me get rid of this. I'm trying to clean these charts up a little bit. So you had the break ahead of earnings to this volume profile distribution, and then a really nasty gap here. Maybe you make it to retest these lows. It's very possible. Maybe look for a retest of a higher low. I was hoping this was going to be a little bit more dramatic into Friday. I would love multiple days down into this area to sell puts. Like here, look, you've already had 1, 2, 3 days of selling for the big gap, and then maybe you get a couple of more. I would be into selling some out-of-the-money puts here for at least a right or right-out bounce. But on a bigger time horizon, this is looking a little, I don't want to say head and shouldery, but it's looking a little iffy. You've had a lot of tests down into this area. 1, 2, 3-ish. I'll count this whole thing as 3. So the fourth time, listen, it might hold, it might not. You have a 200-week moving average just below here, so I don't know how crazy a snap really can get. But I do know that a 50-week moving average here was very important, and we stalled right at it. Look, this is basically this. I'll count this as one big test. 2 tests, 3 tests, 4, almost 4, 5, break below, struggling. Look where the rally stalled, right back at the 50-week moving average, and now a break below. So, I'm not as keen on the Gilead. I'm not loving it as much. One I do like a little bit better, although I'm not loving this weekly pattern here, a stall on the 200-week moving average, is the this Alkermes. I do think it's possible that this does have a little bit more of a fill. Let me show you something. 9-week daily. You've been in an uptrend. This was an earnings day. It kind of had this actually looked a little bit more bullish the other day. You had a trend touch that reversed higher, and now you're a little bit back below the breakout point. So let's be a little bit cautious with this range low. Anything below 39.17 to me might get a little bit iffy for a pullback. Maybe it wants to retest the 50 MA also. I do think that here, given where it is in the volume profile, would be a good right or right out area to sell some puts or even to buy stock. Let's go into SPY. I was going to do some other things, but I did wander off the reservation a little, so I want to play catch up. I was going to talk about gold. Maybe I'll do that in the weekend, the other one, the Periscope. Anyway, SPY, the expected move this week is $3.44 approximately. That would take you up to about 209.77 or down to 202.90. Let's take a look where that would be. 209.77, I said. So that's roughly up to these highs. 209, yeah, exactly. 209.76, so 209.77. So you'd basically be back up to the highs. And we're frozen, God, or down to roughly 202.90, which is just below the 50-day moving average. What's the low here? 203.09. So roughly to these lows. All right, so my thought is this. The pattern here, as I've said, of these multiple days of selling, this to me, this whole pattern here looks a lot like this pattern. You had the breakout, the move back, to kind of retest the 204-ish area. It had a lot of tests there, and then it broke out. Now you just basically filled this gap, and you held the breakout point. There could be some more room down to retest that 204.12, depending on how you draw the trend. You can draw it from this low, the higher low, up, or you can draw it from this low across. You have a 50-day MA roughly around these lows that may want to get retested. I will say this. You had these kind of couple of down days here. These were poor highs. Friday, believe it or not, even with the excess here, had poor lows, as I had pointed out earlier in the S. You've had those couple of days where they've led to bigger moves. That's always when we've lost the 204.12. That wasn't the case here, so I think that would be a bit of a stretch to think that would be the case here. You held the key levels. You are slightly below the 206.76 to me, which is a little iffy. We don't have a full gap fill here. I will say this. If you do get a move over the high of day of the 207.13, particularly if it's a gap, when I talked about earlier hopes and fears, if you're short, and shorts, believe it or not, often exercise more discipline than longs, I would use the high of day here as your kind of your stop out. You had this one on this day, it would be over the high of day here. With a hammer like this, if you have opposing tails, I think that the move over here would be a stop out, and you'll probably get a move back higher. If this is taken out and those poor lows are repaired, it's going to matter of how long that sticks. And I do think it's possible those lows were super duper poor here, that there could be repair, maybe even down to the 50-day. But, I think this area is probably more where you want to be covering than initiating shorts. Just based on the tone and the breath and all that, if I start seeing some really like a gap down and go with 8-to-1 negative breath, maybe they get it down to like the 201.90. But like I said, these 204.12s were really, really tested and retested and tested again and again. So, I would assume that this has to hold until it doesn't. And, if it does break, then we could do some reassessment. I like Friday's range as a gauge if you're really row. I think that if you get a snap of these lows, you will get a bit of a plunge, probably a plunge down to the 204. Maybe even you get a quick spike down to the 50 MA. So, but right or right out. You're going to have to kind of be twinkle toes quick, in my opinion, to kind of catch that move. Anything over the high a day, I think it's a play back to the upside. I think we've had a little bit of weakness in some of the big stocks, which I'll talk about later, which I think has led to a little bit of the weakness. IWM, I haven't really been using this as being all that useful lately. You had a break of the down channel. Here we've retested the backside of that in the 20 MA, and it's held so far with a gap fill. I'm a little iffy with trading the IWM. I haven't traded it in a while, but I mean, for the most part, still kind of holding this trend here. Even if you draw the secondary, I think it's still considered a hold. Yeah, I mean, look at this. You know, it's basically still. Wow, I got a lot of lines on this chart. Very, very messy. Get rid of this, or at least brown it out here, or gray it out for the moment. Yeah, so this to me is just consolidating. I wouldn't make too much. You had a 50, I'm sorry, a 200 and a 220 and a 200 MA and a backside of a channel test. If you get below there, maybe, you know, it gets a bit of a further move down to the 108s, but as of now, it's sort of just, there's really not that much to see here based on this volume, you know, the edge of that volume distribution. And where we are in here, we had a bit of a test into the box that rejected. That's to be expected. Really, honestly, the same thing with SPY. Look at the high volume node up here, roughly around the 2.9, 210 had been a really key level before, 210 to 11. It doesn't surprise me that we got there and we got a little bit of selling action. You know, listen, you do have a lower high here and now a lower low. I guess you could make the argument that there was some kind of a downtrend starting, but for me, the horizontal levels are what's key, and for me to really start getting super duper bearish here, number one, you really have to get below the 205. Listen, I was warning up here that to lighten up longs. You know, I was saying that I know a lot of people are way more bearish than I am and thinking maybe we revisit the low end of the range. I have not seen anything in my view that says that is imminent and could happen. I take it from level to level, and you know, I don't make end range assumptions. I mean, yeah, look, there's an empty gap down here in the 186s. Will it fill? I mean, maybe at some point. I haven't seen anything as far as the heaviness in terms of selling that has me believing that is like an imminent move back down to the lower end of the range. If anything, you know, we're just basically a stone's throw distance away from all-time highs. It wouldn't surprise me to see new all-time highs, particularly if the Fed is going to, you know, the only times we've had these kind of tantrums is when the Fed has really, you know, stepped in and raised rates or threatened to raise rates. So as long as we're holding this upper distribution, I think I at least sort of think that the move should be and can be higher. One of the other things, bigger picture, you had this should have really been it, right? I mean, you had the move here, you had this big rounded top, a move lower, you had a higher low. Okay, a move back, I totally understand. It rejected, another retest, fell apart, retested these lows, and they held. Now you're back up here. This really should not have happened to be back up here if the market was imminently falling apart. If anything, you know, this could form some kind of like inverse head and shoulders here that resolves to like some kind of blow off top. You know, listen, this was a lot of chop in here. There could be a lot of chop in here for a while. I know we have the sell in May and go away crowd. Seasonally, it's not the best time for the market, but listen, it's very possible to have, you know, that move before any imminent move down. Just saying, as they say. Q's showing a little bit more weakness here. This could lead, believe it or not, if the bears want to kind of stake their reputations on a move lower, this would be the one to, I think, maybe kind of try that with, because given the weakness in Apple and Google. Although Amazon is doing well, and as was Facebook, so it's sort of a bit of a mixed picture here. You have a kind of a trend. You had a move above, now back below. I've talked about these 105s areas and the key to it. Look where this big volume node is. So we'll have to see how this holds. I think a lot of the weakness here is you can easily attribute to Apple. And I'll talk about that right now, because I think that really was the... It's a really important situation. Take a look here. You have a really big kind of rounded top, head and shoulders. This was the breakdown, maybe, the check back, and now we're back down to here. So these 92 area is really, really important. I did a poll in the week. People have been pretty, I think, bearish and sour on Apple, given the rate of the move down and their junky earning numbers that came out. So the problem for Apple, And I've talked about this before. I talked about this on the earnings gap down, and I said I thought we had a little bit lower to go, was based on this, is you still have a lot of people, analysts, who need to make revisions. You have a lot of people, a lot of overhead supply, all the people that bought up here who are now wrong, and long and wrong. And you also have a lack of catalysts until June, the Worldwide Developer Conference, and you have still one more earnings report that will probably not be so great, ahead of the iPhone 7 launch out in September or October. So there's a lot of there's a lot of reasons not to be long Apple here. How low could Apple go? I think that we will probably get a little bit more of a bounce off this 92, but if the 92 level goes, I would think 85 to 84 really quickly where primary trend is, and I don't know if this will happen, but it would not surprise me to see this completely round trip close to the 75 or maybe even 70 level, depending on where you want to say the run started from. That would cause a lot of heartache. It would just be one of these big, kind of moves. So I know it's crazy, but it's really is very possible. We'll have to see how that plays out. On the other hand, that's a longer term view. On the other hand, Apple gaps do like to fill. Would not surprise me to see this gap fill at some point, maybe even if the 92 holds. If you want to play row long, you can do a move over 94.72 with a stop below 92.51, I guess. Or if you want to, be all you can be, a stop maybe below the body of this range here in the below the 93s. So I wanted to talk to you guys a little bit about what has been happening here, and a lot of the move down is because of the options. So you had a bit of poor highs here, and this was the day where they did that wash down. I talked about this at Nikkei at like 2 o'clock in the morning on an options expiration Friday. Came out with that iPhones might wound up being the case, so I guess it was correct. But I believe that this really started out as an options wash down, and I think once everyone kind of saw this, and it wouldn't be surprising to me if Carl Icahn sold here. We all know he's out, which is what caused the rest of this weakness here. But once people saw this, I think they took this as a move to the exits. So you have a lot of selling ahead of the move back down to 92, multiple days. So it does not surprise me that this here held at least for a bit of a bounce. I think it could be a bounce to a lower high again and then come down, but this is really key area. If this is lost, it could be signaling much more problems for Apple and potentially for the market. We'll have to see how that plays out. But like I said, I do think bigger picture, it's possible that it comes down further, particularly ahead of these earnings, but we may also see a fill in the interim. So it's going to kind of be a matter of if this and that. Anything below the earnings gap low of day, that 95.68, to me is a little bit of weakness. And I think that's really what pushed this when Icahn came out this day is really what accelerated the selling. And I talked to, 95 options were the big OI. I think they were like 16,000 or whatever. I forget what the exact number was. But once you blew through 95s, think about this. If you're long 95 puts, that means market makers are short those puts. So what do they do when the stock crashes through 95? They're forced to sell stock, taking the shares even still lower so that they don't take a beating on their shares. That's they basically they're just being market makers. They're not playing the market. Or if you are playing the market, you're an individual seller. If you're, let's say, you're short puts, long those puts, you could also short the stock. So that to me is the I'm not saying that right. If you're long the stock, you could buy the puts. That's the inverse. So if you're short the puts, which the market makers would be, you'd have to short the stock to neutralize. If you're long the stock, you would buy the puts to neutralize. So I think the lull of that put a lot of pressure on the stock to go lower. But like I said, this is coming. Look where we're coming from, all the way up at 112 in a straight line down to 92. I can't blame anyone for taking this as a right or right out trade. It's a good one. It's a good probability trade. Anything over the high of day on Monday, I think is a right or right out long. That's the way I'll play it. So that's Apple, the delta hedging. The opposite picture of Apple is a company that does still have real growth, and that is Facebook. We got right up to the progression line, backed off a bit. Anything really over these highs, the 116s to 117s, to me is still bullish. I think you just had some profit taking and selling here. I said that I like buying this on weakness. You got a mini shake and bake here. I mean, geez, it couldn't even get down that much. I was really hoping for a move lower, even to trend, to really scare the bejesus out of people before the print. No such luck. This is all we got. Gapped up. I like buying dips. I mean, look what happened here. You got the rally, made a few more days higher, then came back and filled the gap. So if you get any gap fills, they are buyable. I also like playing put ratios for that if we get a move lower. At this point, though, I am thinking we see this 1.618 fib extension up to 130.43. So I don't know what the order is going to be, but I think that is in the cards in the future. I was going to talk about Twitter, but we're running low on time, and I don't really think that we need to. Amazon, we have a trend here. I talked about it getting up to the gap fill and being a sale and a back off to at least trend. Wow. Yeah, so they blew the doors out off of earnings. The bad news is we are getting close to this gap fill and the channel top. So any moves up into this area might be met with a little bit of initial selling. I think this will probably work its way up there. I don't know that it doesn't need to do some back and fill first. I believe it or not, like selling strangles, meaning selling out of the money calls and selling out of the money puts. I do think at the very least this is going to have a little bit of consolidation. Look what it did up here before. All these people who were long and wrong are probably going to be excited to be getting their money back. You can see they did sell it. So I think could be a little bit of sideways action. That's kind of how I like playing it. Would not surprise me to see Amazon make all new all-time highs. I mean, their print was a thing of beauty. Bezos, hats off to him. That guy really did an amazing job. I mean, I think they took Amazon Web Services from like about $100 million of revenue up to like 600 and change. I mean, that is real, true. That's what Apple needs. That's what everyone needs. That's really major growth. Netflix has been a bit of a disappointment, to say the least, although this selling here has been a little bit begrudging. There are a lot of hammers in here. I think the 90 expiration here saved it. If you were to get a gap over trend, you'll probably get a bit of a short squeeze. This is coming down. Maybe it gets back down to the 86s, but after this many days of selling, I'm starting to think bounce. At some point, this gap will probably fill, but, I've talked about bigger picture. Let's see, that this is starting to look a little roundy and you have a bit of a trend snap. I don't know if this is just in a big sideways consolidation pattern or if this really wants to come back and retest the 70 breakout point, or I don't know where it'll be at the time. The primary trend, very, very possible, but I think that you'll probably see a move back to at least the 50 MA at some point before that can happen. Let me get back into more modern day. I like this trade over the hammer high for a right or right out play. But if you start taking out these lows, this could get a little bit cascadey, maybe even down as far as to the 80. Believe it or not, it could kind of be doing one of those moves. So I like the Friday range sort of as the litmus test. A couple of causes for concern would be being below these dump lows, the 93.55 and the 92.38. I had thought anything above these two highs could set up for a long, this very similar situation here. This hammer could have been a look below and fail. This might be the same. We'll have to see. I just don't think that this is all she wrote. Like you're going to get the move down to the 70 without some type of a move higher. I just don't know that we're not going to get down to the 80 before we see the bounce. So I'll be keeping a close eye on the Netflix. After this many days down, to first short here isn't really my style. I'd prefer like some kind of a rally up at least to the 50 or even to retest the gap for some type of a short trade. The Google, I don't like to mess with this thing until it's either at a channel low or at a channel high. I think it could fill back into the 680s like I have been discussing. It looks like that'll be the case. At that point, maybe play some put ratios, or even if you want to just sell some out of the money puts. But I do think that this will likely at some point see the channel low again. That's just sort of how Google rolls, right? Microsoft, a little double, triple toppy. I am looking to buy this one. I just don't know where. Somewhere here in either between the 48s and the 45s, I think. I'm not really sure where. My luck, it'll turn around and just fill the gap on Monday or Tuesday, early next week. But I think down in here, I'll be selling some out of the money puts because I do think that thing has a date with 60 at some point. I think that about does it. Yeah, I just think that there's a lot of rotation out of these names into like the FCXs of the world. Look at this, up and away. I had been long this for a while. I'm still long. I'm just not as long as I was. I wish I was still longer. There's a long way to the downtrend. I don't know why this is green. Should be red. There's a long way to the downtrend line. I don't know that we're going to get all the way there. I drew in some Fibonacci retracement levels. I was thinking maybe here. Anyway, we're getting a little close to the channel top into these reference highs. It might be a good idea to let some out there and then kind of reload on a pullback. But maybe we are spring-loaded for a move back up here. I think we're going to 1720s. That's my thoughts, and then maybe eventually to the downtrend. Anyway, I think we're gonna end it there. That's my story. I'm sticking to it. If you like this video, hit the thumbs up. Please be sure to subscribe to the YouTube channel. You'll get to see weekend review videos, Periscope rebroadcasts, and special edition videos, which I highly encourage people to watch, particularly the risk management and the explanation of poor highs and poor lows, the basic look at the market profile, kind of like the market profile for dummies, so to speak, if you don't really want to look at TPOs and get too geeked out. Alrighty, leave some comments, and I will see you during the week. I'm going to aim to do Periscope. My guess is somewhere between Tuesday and Thursday, maybe Wednesday. Anyway, I'll post that on the channel. Let's have a great week, and cheers.